In this video, I'm going to talk about the reconciliation between net profit before tax and cash generated from operations, which is the first component that goes into your operating activities on the cash flow statement. Now, to remind you of what we've already done before, I'm going to show you this this part of a previous video. So I want to deal with this first part here, which is your cash generated from operations, which is the first component that goes to your operating activities in the cash flow statement. So what do we do in this particular one? You're going to start with your net profit before tax. Okay. Now, and take note that when you're dealing with the cash flow statement, depreciation is a non-cash item, and then interest expense is applying the rule of materiality, as you've already seen on the previous information that I showed you. It means it is shown separately in your cash generated from operations or in your operating activities. Now, so I'm going to make adjustments in respect of, first one is depreciation. So depreciation has to be added back because depreciation is a non-cash item. And then interest expense has to be added back because interest expense using materiality is shown as a separate figure. So this gives you operating profit before changes in working capital. Okay, operating profit before changes in working capital. Now, when you're talking of working capital, you're basically talking of three things here. I'm going to put a small box here. Right, operating working capital. Remember, if you remember from your ratios, working capital is made up of three things: debtors, creditors, and the inventory. So what happens here is you're going to have firstly, it could be an increase or decrease in inventory. Right, so I'm going to do that. Okay, so an increase in inventory, it means you bought stock. If you bought stock, it is negative. A decrease in inventory means you have sold stock, which is positive. Money comes in. Okay, so if I'm to remind you from what I've said before, when assets increase, it's negative for the bank account. When assets decrease, it's positive for the bank account. Because when assets increase, it means you bought, which is negative. If assets decrease, it means you have sold, which is positive. So that will make it easier when you get to the second one: increase or decrease in trade and other receivables, which is your debtors. Now, so obviously, I've already mentioned, when an asset increases, it's negative. And when an asset decreases, it's positive. And then that also makes it easy for you to remember the last one: increase or decrease in trade and other payables, which are your creditors. So like that, it will be the opposite. When creditors increase, it's positive. When creditors decrease, this is what? Negative. And then at the end here, you're going to get your cash generated from operations. This one. Comes here. Okay, which can be positive or negative. So what it means, that first figure, right, this one, cash generated from operations, is obtained by doing this whole calculation: net profit before tax, then you add, you adjust in respect of depreciation and interest expense, then you get your operating profit before changes in working capital, and then you've got your increase or decrease in inventory, trade and other receivables, and trade and other payables. Now remember, critical: when assets increase, it's negative. When assets decrease, it's positive. When creditors increase, it's positive, and when creditors decrease, it's negative, because it means you've paid them. Thank you.